Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello, and welcome to the Stock Play of the Day. Today's stock is going to be a Homebuilders ETF. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie. Well, I'm going to show the chart here of the S&P 500 index. We have a daily chart going back to December, and we're really seeing, once again, a lot of chop in the marketplace. Now, we had some excitement last week. The most exciting thing that has happened in quite a while. The market was actually down a little bit, but guess what? The market took it right back. And we see ourselves once again trading between the 20-day moving average and the 50-day moving average. A little bit of chop in the marketplace overall. But the fact that we did have the big down day and actually got it all back before the end of the week was a fairly strong side for the marketplace. But once again, we're back into that area where we're just chop. So what do you see going in the markets going forward?
Yeah, Brian. Well, we're back to boring markets, just like you said. Stocks did bounce back strongly after selling off about 4% last week. And the rebound has been led by a pop in tech and growth stocks. And like you mentioned, Brian, it is encouraging that we saw stocks bounce back so quickly. We've been saying for a while that any quick sell-off will be bought quickly because of lots of buying interest out there in the markets. And that's exactly what we saw. So now the S&P is hovering right around the 20-day, right below records. And it just seems like we're back in quiet markets mode, just a feeling. There isn't much to watch this week either. The biggest thing on our radar, retailers like Target and Walmart are reporting earnings this week. In fact, Walmart actually reported this morning and had a really good earnings report. And the stock is up about 3% now. Other retailers like Home Depot and Lowe's are also on deck for later this week. So we should get a better sense of consumer health from those reports and earnings calls. So one interesting chart actually that I've been watching, Brian, was one of retail sales and inventories. Speaking of retailers, apparently in March, there were more sales than inventories in retail sales data for the first time since the data began in 1992, which is a striking chart. It's a super interesting data point, and you know what it tells us? It shows us that high demand could be a limiting factor for retailers if they can't keep up with stuff on the shelves. I mean, yeah, apparently there's a thing as too much demand, and we're seeing it all around us these days. And guess what that could lead to? Higher prices, i.e. inflation, and that seems to be squarely in the market's worry bucket these days. I'll add to that we still think any inflation spike will be temporary. We're in pretty extraordinary times right now, like we have been for the past year and change. But we are watching that very closely. And frankly, we're pretty stunned by the data we're seeing. So we're watching retailers' earnings and commentary this week. And there's also a slew of housing market data, which, spoiler alert, we'll dig into in just a moment. So overall, it looks like summer's starting a little early, Brian. Things are quiet again, and there aren't as many headlines to watch for to get clues on where the market goes next. So be prepared for low volume and wandering markets, aimlessly wandering. I almost said that, aimlessly wandering markets for the next few months with an occasional quick sell-off, possibly like the one we saw last week. But any quick sell-off, we believe, will be bought as quickly as well. Still a lot of buying interest out there. By the way, if you want to read more about stocks during the summer, check out our latest weekly viewpoint. It's all about summer seasonality and why it could matter more this year because it's a hot back summer. So definitely check that out. It's at ally.com/do-it-right. Lots of good nuggets in there. I would know. I wrote it. So that's pretty much what we're watching in the markets today, Brian. Tell us what you're seeing in the VIX.
All right. Well, the VIX still seems to be capturing some headlines, and the want to know as far as the VIX is concerned hasn't really gone away. So we see the VIX right now at below 20, 1979. It's still just kind of hanging there. I'm going to pull up the chart of the VIX index. It goes all the way back, shows the big downturn in 2021 in March once the announcement of the pandemic came out. And we see that, yeah, we did have a little bit of bullishness as far as the VIX is concerned. We took off a little bit of the concerns in the marketplace as we were setting some new highs. But then again, man, it doesn't take much for the VIX to spike. And we got that little downturn, a few percentage points last week in the S&P 500, and we spiked instantly up to almost 30% in the actual VIX index. So if I scroll up a little bit in my VIX watch list that we talk about every week, we do see the August contract at 23.47. Now, to me, the biggest thing that can happen in the VIX is that you see the actual futures come down and start trading about where the spot is at or actually below. That's going to be the first sign in a while that there isn't as much market concern based off of just the volatility in general as we go out in time. It's been kind of amazing to me that I'm looking at the August futures contract and it's still trading at about 23.5%. Now it's below 25, and it took forever for the longer term options to get below 25. So overall, that's a good thing. But in general, the VIX is still elevated, and it doesn't take much to make that VIX index spike. Okay. So today's stock is going to be a home builder. It's the S&P it's the S&P Homebuilder. The symbol is XHB. And I have a chart here on XHB, and it's very similar to the S&P 500 index, actually. We see that a lot of chop, big run up, a very strong bullish move since March, all the way to a new high. Now the market is sold off a little bit, a couple of big red candles, and we're trading between the 20-day and 50-day moving average. So the home builders, a lot going on in that space. Interested to hear what you have to talk about. But obviously the price of lumber, housing starts happened today. So a lot of data in this area. So what do you see in home builders this week?
Yeah, Brian. Well, it's an interesting space for sure. And there's a lot of things going on. Honestly, I picked the home builders just so I could hear you stumble over the stock name at the beginning of the show. But, it's also a really interesting space. I mean, home builders have been one of the hottest spaces in the market this year. And when we say home builders, we're talking about construction companies like D.R. Horton, Pulte Group, Lennar, big home builders like that. So companies like these, they benefit from people who want to build homes, of course, and they can charge more for higher material costs, i.e. lumber. And we all know that lumber has been soaring, up until about a week ago. Home builders are actually up about 30% this year compared to the S&P 500's 11% rise. So when I say hottest space in the market, I'm not kidding. That's not too shabby at all. But we could be reaching a breaking point. The foundation might be crumbling. Home builders have dropped as much as 9% this month as lumber prices have plunged 20%. So lumber prices were on the way up for a while, and now they seem to be on the way down quickly. And we did get some interesting data actually today, Brian. Data today showed housing starts slowed way down in April, while building permits rose slightly. So how do you read this data? So building permits are the first thing you look at. Building permits are like the ultimate leading indicator for home builders, because when you build a house, the first thing you do is get a permit to start building. So housing starts, which are kind of like the second leading indicator for home builders, it's kind of like a leading / concurrent indicator. Housing starts actually plunged 9.5% in April. So this is actually the interesting data point to me, because we've been hearing anecdotally that ultra high materials prices and labor shortages, like we saw in the April jobs report, have led to construction sites stopping work around the country. And this data aligns with that story. So things are looking a little murky for the home builders over the next month or so. And we're seeing that play out in the market right now, Brian. But, we believe there are still lots of reasons to be optimistic about them long term. Number one, we're still bullish about the housing market in general. Demand is still very high, and we think this could continue because most of it, or much of it, is demographically motivated, aka millennials like me buying homes. There's also more of a push to build now instead of buying an existing home because there's lots of demand out there for existing homes. And the inventory for new builds, and then pending builds has always been low since the financial crisis. So we're starting to see a shift in that as well. Home builders themselves remain pretty upbeat too. Even though activity is slowing down, the National Association of Home Builders Sentiment Index, it's an important index to watch for sentiment about the housing market, is still near record highs, showing these companies feel really good about their prospects. And earnings season, I know earnings season is almost over for most stocks, but it's actually about to begin for the home builders. A lot of the big names for home builders report earnings in June and July. Home builders have crushed earnings expectations recently, and even if they stumble for a month or two here, we'd expect their guidance to stay pretty positive. And that could be enough to boost share prices. Now, this is a macro play, not a stock play per se, although we are watching stock play of the day. And that's why we're looking at a fund of multiple home builders instead of a single home builder here. So to sum it all up, we're long-term bullish on home builders. There are a lot of weird factors going on for the space right now, and you're seeing that manifest in the stock price. So short-term, we're not really sure, home builders could go higher, they could pop on earnings, or, if things get worse, we could see home builders sell off a little more, but we see any sell-off as an opportunity to pick up more shares. So Brian, I think we need an options trade that's bullish long-term and could be opportunistic in case the pullback continues in home builders. So I'm going to pass it to you in a second. But before I do, I'm going to remind all our viewers to drop your questions in the chat because Brian and I will be answering them live at the end of the show. Very exciting. All right, Brian, show us the options trade.
All right. So we've had a few advanced option trades. Actually, a couple of weeks back, we looked at a ratio spread or two. We did a couple of fancy things. We did an iron condor here on the stock play of the day. So we're going to get back to the basics. And one of my favorite trades overall in a market like this, and as always, nothing's meant to be a recommendation here. We're just trying to learn. When you look at market conditions, you have a little bit of an elevated VIX. It's been elevated ever since the pandemic got announced last March 2020. And because of that, there's been premium just in stocks in general. So wanting to buy a stock at a lower price, one way that you can accomplish that is just by putting a limit order in, saying if the market comes down to this level, I'm willing to buy 100 shares at X price. Today, we're going to do a function of that. We're going to sell what's called a cash secured put. If you are bottom fishing, and we kind of see the chop in the marketplace in the home builders, also in the S&P 500 index, trying to figure out where they might be going next. And the trade that we're going to look at here is something that will allow you to buy that stock at a lower price, but will take advantage of the fact that there are some inflated premiums overall, and they'll pay you now for saying that you are willing to buy the stock at a lower price at a later date. So that strategy is actually called a cash secured put. And I'm highlighting that inside our options playbook right now. And I'm going to look at an alternative to the cash secured put because of the nervousness of the marketplace overall. But what a cash secured put means is that I pick a strike that's below the market and I say, okay, I'm going to sell this put. As with most things, when you sell something, you get cash now. That cash you can put in your pocket, and you're going to say, okay, if the stock comes down to my strike, you can put that stock to me, and I'm willing to buy 100 shares at that strike. Now, what makes it cash secured? Well, you got to have the money to buy that 100 shares. If you have the capability of buying 100 shares at that price, and you are intending to buy that 100 shares at that price, well, then that would be considered a cash secured put. And guess what? You can do these in retirement accounts, like IRA accounts, Roth IRA accounts. As long as you are secured by the cash, it's very similar to putting a limit order in below the market where you would have to have the cash to be able to buy the stock at that limit price. Now, in the options playbook, I'm highlighting the fact that we're selling strike A. Usually the market is somewhere up here, right? It's usually above where that strike is at. And this is the stock price referenced in our graphic. So what I have done in the chart is to say, well, if I'm really doing a cash secured put and I want to buy the stock. I just want to buy it at a lower price. So if it comes down, the dotted line represents that we own the stock. We own it at a lower price than where it was currently trading. And where we'd be buying it at would be our cost basis, which would be the strike price minus the premium received. And that would be our cost basis for owning the stock. And then we have all the risks and rewards of stock ownership. Unlimited upside, substantial downside. Stock can go all the way down to zero. Can't say unlimited on the downside because it stops at zero overall. But that's what a cash secured put is. So let's start by looking at that. That'll be the official paper trade for this week. We're going to avoid earnings. And that's one of the things about cash secured puts, or even covered call writing, which is basically the sister trade to cash secured put selling, is I don't really want to do it around earnings because I'm making this commitment to buy that stock. And I don't want that volatility of that earnings report. So a lot of time, if I'm doing cash secured puts, I'm going to avoid that. And as Callie has mentioned, in the middle of June and in July, a lot of the home builders are going to be reporting. So we're going to go out to the June 4th expiration. We get 17 days, got a little bit of volatility. If we even just go down a little bit, the stock right now is at 74.43. It's down about 1% or 72 cents on the day. So it's a good day to put this position on, bluntly, a little bit of a down day because we're kind of bottom fishing anyways. And we're going to sell that 72 strike put. So inside the Ally Invest platform, I can do it either by clicking on the bid price, or I'm going to do this and I'm going to add a sell in the right rail. Now, I should probably emphasize that these are puts, these are calls, stocks at 74.43. This is the actual checkbox to try to determine what my strategy is. And now we look at the strategy workbench. And here's where what we're working with. We're saying by the June 4th expiration, if the stock comes down and finishes below 72, we're willing to buy that stock at 72. We're going to go and put $7,200 in our account and say that we will buy 100 shares at that price. We receive a net credit of $1, approximately, we say $1.98 to the account. And if I put it in the right rail, that makes it official. This is the official paper trade for the week. Let me scroll down a little bit here. And right now, I would work the midpoint. I would maybe try to get $1 for this. We got kind of medium markets here in the XHB. So I'll put it in at $1 just to make life simple for the overtime, which we're going to be having on Friday. But if I do this and I have that stock and I'm saying I'm willing to buy that at 72, if it's in a retirement account, I have to have the cash. That makes it cash secured overall. But I have to be able to buy it at that strike price. Now, ideally, I only need $74, right? $71 in my account. Why? Because that's 72 minus the premium. I'm going to get that cash right away in my account. And I'm just saying that if it comes down, I'm willing to buy that stock at that expiration below that strike price. Now, that's the official paper trade, and we'll make that official. Now, let me remove this right rail. I'm going to get rid of that right now. And we'll just look at another alternative. If you're nervous about the marketplace, like the VIX is implying that we all are, you can also do what's called a short put spread. In other words, I can come on in and I can sell that put. I'm bringing in about $1. Now, if I'm willing to if I'm really nervous about the markets just in general, maybe inflation concerns, maybe cost of materials, maybe something is making me a little bit more nervous. Still like to own home builders long term, but in the short term, I'm a little nervous. As I can sell some of that, I can sell that premium for that put, saying I'm willing to buy it, but take some of that cash and actually buy some protection. So strike B here is my main driving factor in this strategy, but I'm going to go all the way down and buy a less expensive option contract just to protect and limit my downside loss. Instead of having this loss the whole way down, at one point in time, I'm going to stop the pain. And that's a short put spread. if I'm using the same expiration, I'm going to let you decide, like, how much risk would you want to do if you're going to do the short put spread? You can sell the 72. Maybe you buy the 70. You don't get much premium then. Maybe the 68. That's trading right around 30, 35 cents, maybe 67. You're looking at 20, 30 cents. But it's just the further you go down, the less protection you get. But it's a trade-off because you bring in less of a credit. So that's just an alternative. The official paper trade is actually going to be a cash secured put, saying that if the stock does go lower, we're willing to buy more. So let me go out and just I'll grab the 68 strike put, and I'm going to go and look at our profit and loss calculator. And I'm just going to show you that these are using live quotes, as we always tape this live, the stock play of the day. This is what it would look like in our profit and loss calculator if we did the actual put spread. Here's where the underlying stock is at. We're saying if it comes down to 72, we're willing to buy it. But if it goes all the way down to 68, we're going to stop the bleeding. We're going to have no more risk from that point on down. We still might be willing to buy the stock, but this strategy by itself will be protected from 68 on down. All right, Callie. Well, we got quite a few questions in there, and I thank you for putting the questions in the chat box. If you have any more, put them in. We'll try to address as many as we can. So I'll pass it back to you, Callie, and let you pick which one we would like to answer first.
Yeah, definitely. Well, I'm seeing a lot of hellos in the chat. Hi, everybody. Good afternoon or morning, depending on what coast you're on right now. I have a question actually from last week, and I know Wayne asked it, and I promised I would address it, so I'm going to do it really quick. So Wayne asked last week what the difference between growth stocks, value stocks, and momentum stocks are. And I actually think the home builders are a good example of where the line blurs a little bit. So growth stocks are high-flying stocks that trade on future expectations, like tech stocks. Value stocks are steadier stocks typically, and they tend to be more economically exposed. So investors buy and sell them for the value they provide now, or the growth that they're seeing now. And typically investors look for, in value stocks, they look for prices that are cheap relative to earnings. That's the value part of it. Momentum stocks are stocks that have done really well or really poorly lately, and investors buy it because they expect it to keep moving quickly in the same direction. So I say all that to say home builders are actually a really interesting case study because they are, if you think about them, you'd expect them to be a little more value, but they're acting like growth stocks these days. They tend to be trading more on future expectations. And that actually plays well into our trade, Brian, because we are long-term bullish on home builders. And if we expect the market to see it our way, we'd expect people to keep piling into home builders based on an expectation for good future growth. So that was that answer. Let's see. I have another question from Wayne, and this is a tricky one, but I'll take it. So Wayne says, hey, Callie, got 3 for you. With the US dollar dropping, do you think gold will rally? Will higher inflation bring the dollar back up? And how low do you think the dollar will go? Oh my goodness. Well, this is a really tricky one, Wayne. And I'll say it's tricky because there are a lot of historical correlations between gold, the dollar, and inflation. But we've seen correlations break down. So I can't definitively say anything will happen because I don't know what the future holds. But I think it's especially hard these days to predict what's going to happen, especially with like commodity prices and the dollar. So I'll break it down really quickly. So typically when the dollar drops, gold rises because gold is like a hedge against the dollar. Right now we are seeing the dollar near a multi-year low. And we don't expect the dollar to really react too much until the Fed acts, until the Fed moves closer to tapering or moves closer to raising rates. We think that could happen sooner than expected because of inflation. If this inflation spike that we think is temporary actually, lasts a little bit longer than expected. If we see higher inflation, that's supportive for gold because gold is also a hedge against inflation. And I can't remember if I said this a minute ago, but inflation is also supportive of gold because it erodes the value of a dollar. But all of that to say, gold is a really funny animal and it's moved on a lot of different factors. It's actually spiked quite a bit since a year ago because it's been used as a big safety trade. So I wouldn't pin gold's movements all on the dollar or inflation. I tend to stay away from commodities just because they're a little haywire these days. But those are our thoughts. We think a Fed surprise, a Fed move could be one of the big surprises on the horizon. We see it as low risk, but it's definitely still there. All right. So I have a question from Corto Sawyer. Corto asks, hi, Corto. He asks, I have an investment below $1,000. Can I sign up for the managed portfolios? And he has a follow-up question that says, do I have to pay fees and a commission? Well, good news, Cordo. Our managed portfolio minimums are $100. So yes, you can invest $1,000 because our minimum is way lower than that. There are fees. There is a no fee option if you opt for a higher cash buffer. But all the details about that will be on Ally's managed portfolio site. Just Google Ally managed portfolios and you can get all the fun nitty gritty details there. And we have a little shout out from JG. Guys, I can't talk today. I'm sorry. Hi, JG. JG says, I just want to say thank you guys for recommending XLF as a stock play of the day a few months back. It has gone up a lot. I know, pretty exciting. Definitely a rate play there, JG. And then the follow-up question is, do you guys continue to feel bullish on finance and banking sector stocks? We do feel good about financial stocks, JG. We do think that there's still a really interesting rate play. And if we see inflation pick up, we expect to see rates pick up as well. And banks tend to make money based on the yield curve. They tend to lend out long. So when long-term rates are up and then short-term rates are low, that's a good spread for banks. And if the Fed doesn't act, but we see inflation tick up, that spread could widen a little bit. So we think the environment is still supportive for financial stocks. It's a little tricky because financial stocks have rallied quite a bit, like you mentioned. So it's tough to say where fair value is here, but we think the economic environment is definitely still supported. So that was a mouthful for me.
Right. And I'll jump in with the little disclaimer. We don't know your investment portfolio overall, so we can't necessarily make a recommendation for just for you specifically. Not everything that we talk about. We're just trying to learn here on the Stock Play today. So I do want to emphasize that. But yeah, the ETF, a lot of the financial stocks in general have done well, and also the ETF has done well. The good old XLF. And then I'll just take one thing while Kelly's looking through a couple of the other questions. I actually have a chart of gold because I was actually looking at gold recently, and I'm going to highlight this. Now, gold is a very tough trade because it disappoints quite a bit overall. Some people try to do technical analysis by looking at gold, and I'm just going to highlight, like I have my little ray feature here. And here's one of the things. If I look at gold and I'm looking on a daily chart, this is going back. I'll scroll down. I know exactly where this peak was at. But if I look at it and I just connect the dots here, we kind of see that we did have a breakout in gold right here, going all the way back. And we just didn't really take off. A lot of people were looking for gold to take off there. But then if we go out and we actually look at this range from where we're right at a real inflection point. We're above the 200-day. We're just below the 200-day. We're above the 20-day and the 50-day moving average. And we had a good spike up in gold today. So this is a very interesting area. If you see, and I'm just going to click on this. If we come through and we see just these little hanging chads, if you will, these days, where we had a little bit of a spike up and then we failed at that point in time, because that was definitely, once again, I think people were getting excited about gold when that happened, just chart wise. So that it does disappoint, but the chart for the first time in a long time is looking interesting in gold again. So I wanted to go back and toss that to Wayne overall. All right. So Callie, I jumped in, I gave you a little bit of a break. What do we have next?
All right. I think that's also a good point, Brian. Brian is the chartist here, and there are definitely some interesting things going on with gold from a technical perspective. All right. So one more question. All right. Well, I'll say to Albert threw in, would you please look at PTSI? I bought in at $10.50, but now down huge. Albert, we can't give recommendations like Brian just said, but we will have to look at that stock. That sounds interesting. All right. And then Wayne asks, hey, Brian, why'd you pick the 72 strike? Is it based on where the support level is, or is it the percent savings you're getting off the cost of owning the stock? And I think this will be our last question.
All right. We'll make it the last question. And great question as always, Wayne. The 72 strike, there was a little bit of rationale in it. If we look at the expected move, I got rid of the chart. Okay, overall. If we look at the expected move in the home builder, so I'm showing my chains right now, and I want to be within a range because the concept of a cash secured put is that you really do want to buy it. So we want to make sure that the marketplace thinks that it can reach that level by that expiration. So there's a little bit of rationale behind it, but the stock's right around 74.50. If we do some quick math here, we'll let's call it just under $4, right? $4 below here from 74.50 would go to 70.50. So we're within the expected move. And that was the main rationale. I want to get a decent premium. A buck is okay. I don't mind that at all. And I want to be within the expected move, implying that if the stock does make a move to the downside, it's going to reach our strike and give us that opportunity. So a great question, but I'm always paying attention to what the long straddle is at. And I'll go and I'll highlight that. 74.50, that means you would be buying the put, you'd be buying the call. And we scroll down, the midpoint is the expected move, $3.60. 72 is within that range to the downside. So if it does make a move to a downside, it's feasible that we could buy it at that price. Mm-hmm. All right. So that's going to be it. For the stock play of the day, want to make sure that you ring the bell and click subscribe. And as I still Callie's momentum, we'll be here this Friday for the stock play of the day overtime. Myself will go over this trade and we'll talk a little bit about what's going on in the home builders. And then if you click subscribe, ring that bell, you'll get all of the alerts for the next stock play of the day. Thanks for coming, everyone.